Welcome to Business Line's State of the Economy podcast, where you'll find insight, analysis, and the story behind the numbers.
Hello, and welcome to Business Line's State of the Economy podcast series. This is the first of the podcasts focusing exclusively on the markets, and this market series will come to you regularly every month henceforth. Bringing to you insights on the markets every month from experts is your host, Parvatha Vardhini. I am the editor of BL Portfolio, Business Line's Sunday feature on investments and personal finance. The expert speaker in this inaugural podcast on the topic Markets, the Way Ahead is Mr. Krishna Kumar Karwa, Managing Director, Emkay Global Financial Services. A chartered accountant, Mr. Karwa has rich and varied experience of over 28 years in all aspects of equity capital markets and leads the research, the PMS, as well as the corporate advisory division at Emkay. Welcome, Mr. Karwa, to the podcast. The market did touch a peak in July, but since then it's been a little bit wobbly, volatile, one day up, one day down, no clear direction. So if you have to enumerate three key factors that have led to this indecisiveness amongst investors, so what will those factors be and how long do you expect this to continue?
Thank you, Vardhini, for inviting me for this inaugural podcast.
Sure.
And I look forward to a very interesting session with you for all your listeners.
Definitely.
And coming back to the markets, Vardhini, if we have to go back slightly behind, let's look at it this way, that between March and till July, I think Nifty itself ran up by almost 12%, and the small and mid cap indices also ran up by almost 30%.
Right.
And we had robust inflows of almost FPI inflows of between 60 to 70,000 crores in the last 4 months till July. So, and before that, the markets were, there was a huge amount of outflows which happened before March, FPI outflows. So I think what happened was that you had a robust uptick in Nifty, small cap, mid cap indices, robust inflows. And if you look at the valuations also were kind of fair at around 22, 23 times earnings as far as Nifty itself was concerned.
That's right. Yeah.
So it's a very natural thing for market to take a breather, and which is what we are witnessing in the last, 15, 20 days of this month. So one is FPI inflows have turned negative, which is, I think we have seen some 13,000 crores of FPI in outflows, which we have witnessed.
Right.
I think what we are witnessing is also sectoral rotation. So the Nifty may look flat, but if you still look at the broader market, I think they have still given some 5-6% kind of returns.
Okay.
And there is those sectors which did not do so well in the first 3-4 months, like pharma, IT, to some extent even media and realty sectors. So they picked up. So to answer your question, yes, Nifty has gone nowhere, because if you look at it, if you look at the banks, etc., despite the best of results, all the heavyweights, which form almost 40% of Nifty weightage, they exactly did not set the bosses on fire. So it's expected that, that will have its impact on Nifty, and that's what we are seeing, that and even IT sector, there was some correction, some disappointments. So Nifty is taking a breather, but market buoyancy, overall breadth of the market continues to be robust.
Okay. So, but you had mentioned about valuations in the March lows versus the valuation in July. So today it's corrected a little bit. So today, if we see the Nifty valuation, it's a trailing 22 times, or a 1 year forward P is between 19 and 20. And if you see a long-term average of, say, 10 years, it's somewhat in line. So people would definitely like to know whether we would call the markets expensive today, or is it cheap today, or is it rightly valued today? How do you see it?
See, markets are never in balance. I think they will always tend to go to one extreme to the other. And yes, currently we are at we are at, at historical, if you look at it, then we are at fair value in terms of the valuation on an overall Nifty basis. So to that extent, you can say that, yes, we are fairly valued, and markets are continuing, and markets are reflecting that in terms of sideways movements. So markets are also looking at new triggers in terms of further uptick in the markets. I think, and if you look at Nifty itself, then as I said, IT and banking, which are large heavyweights, I think they have to show some movements on the uptick for the Nifty to finally break out of this range. And I think consolidation is a good enough thing. But I would request your listeners to more focus on individual stocks and the opportunities that they bring than get taken in by the underperformance of, or rather the consolidation which is happening in Nifty as we speak. So, I mean, that is a better way to go about it. And I think it's a very good sign. I think the markets are very, very mature, that they are not going into an overbought or overvalued territory, which gives opportunities for investors who have been waiting to enter. My sense is that there is a lot of underinvestment which is still there, and there are a lot of investors waiting on the sidelines to enter the market if there is some decent correction. And let's see how it behaves.
Okay. So you're saying adopt a more stock-specific approach rather than looking at valuations on a broader market basis.
Absolutely. I think there have been so many opportunities for investors to trade or rather invest in the broad market, and they have reaped the gains out of it. I mean, so I think better to be stock-specific rather than getting taken in by the consolidation which we are witnessing in the broad market.
Okay. So have you, without calling out any names, so where do you think the opportunities are today in terms of, either sectorally or in terms of market caps?
Yeah, I think I would say optically it may look like that the small cap, mid cap stocks are overvalued versus the large caps. So that's the sense that you get today. So maybe if you're looking at a broad market cap basis, then the opportunities in the large caps looks like and more attractive than the small and mid cap. That's one way to look at it for new investments to be made. But having said that, if you look at sectorally also, I mean, yes, the large cap banks and all, they are fully owned or very well owned and very well discovered. But there are a whole bunch of tier 2 banks and maybe some of the public sector banks also, where the valuations are attractive, the growth also is equally strong, and the balance sheets are as pristine as ever. So maybe that's where you will possibly see opportunities in the next 6 to 12 months for investors to make decent gains. Even many of the NBFCs, including in the housing finance or in the SME lending, they also seem to be doing very well with very strong growth and credit costs being very low. Some of these attractively valued NBFCs also could be a very interesting space to invest in. Many auto ancillaries, I think, who have got their act together in terms of getting the right EV exposure and by getting the benefit of the consolidation, etc. They also seem to be attractive even at current prices. So auto ancillaries also you will find opportunities. And some of the contra sectors that you could possibly look at where there are headwinds and where valuations have come off because of the headwinds in the last 1 year has been in the agrochemical space and the specialty chemical space. So where maybe I think the industry is bottoming out and maybe stock prices are possibly reaching attractive levels. So for patient investors, there could be an opportunity to invest in some of the top tier companies in those sectors. Yes, everybody is investing in cap goods and railway stocks, but I would be very careful because they have run up a lot.
That's right.
Including defense companies. I don't deny the opportunity, but everything is at a price. And maybe valuations have run ahead. So I would be very vigilant on investing in the flavor of the season kind of companies.
Understood. That was a very detailed account of what one could possibly look at in today's markets. So if we look at the first quarter results, sir, so quite significant trend is that the revenue growth, say for India Inc., we did a study of 1,500 companies about 1 or 2 weeks back. So the revenue growth stands at best at mid single digits, but cost savings from lower raw material costs had aided profits. So profit growth almost stood at 45 to 50% on the aggregate. How do you look at these results, and how do you see demand going in the next 3-4 quarters?
Yeah, on an aggregate basis, what you say, I agree with you. But some of the sectors where there has been decent volume growth has been like cement has done well. Autos have also done well. So I think it's better to look at, on an individual sectoral basis. But on an aggregate basis, what you say is a cause of concern that you seem to be having poorer volume growth versus the realization. I mean, profitability has been strong because of falling raw material prices, etc. So my sense is that what we as investors are also keenly looking at in terms of whether the second half of the year volume will pick up, specifically in FMCG, where rural India, there are talks that there are green shoots of recovery over there and volume should pick up in the second half of the year. So that is something which we are all eagerly awaiting, and so is the case in many consumer durables, where also there seems to be a distinct slowdown. Maybe it is because of sometimes maybe pent-up demand was there earlier, so that has happened, and now it's now all plateauing or it's becoming normal, or maybe because of unseasonal rains, etc., which impacted some of the product categories. So that could be there. So yes, I think there's some kind of a back to normal return, post-COVID return to normalcy, which is happening in some of the sectors. Here, I would just like to add is that, if you look at premium consumption, so whether it is, so all those premium categories, they continue to do well, and their volume growth seems to be strong. So that is something which markets will have to take note of, that somewhere the K-shaped recovery which was there in the ecosystem is becoming stronger by the day, and companies which focus on the premium segment of the market, they continue to do well, and it's the challenge is on the lower segment of the market.
Okay. So as you were rightly mentioning, I thought I will follow up on this trends in consumption. So as you were rightly mentioning, nascent recovery in rural and consumer durables, some portions already is not so great demand. But, we seem to have one or two headwinds coming up in the form of inflation, and then uneven and volatile monsoons countering the rural recovery. Then how do you see this consumption leg of the economy? Like, especially, as you say, the non-discretionary part, if I can say that. So how do you see this panning out for the rest of FY24?
Uneven monsoon or deficient monsoons is a reason for concern, and it could impact agri prices and have its all negative implications as far as inflation is concerned, no doubt about it. But having said that, I think today rural India, what I understand is that maybe 30-40% of their income is dependent on agriculture, but more than 60% of their income is dependent on non-agriculture, which is livestock and infrastructure related work and the likes, I think. So maybe the impact on income levels of rural India may not be as severe as we normally tend to believe whenever monsoons are not spread out well, or where there are deficient monsoons. So to that extent, I believe we are getting into a phase where state governments and central government will be aggressive in their spending as we approach the election. So there will be a lot of liquidity, a lot of opportunity, a lot of work which will flow more in the rural India than urban India. So to that extent, I am very hopeful and positive that the uptick in rural India demand, yes, there will be challenges as far as deficient monsoons or unequally spread out monsoons can create, but maybe the other extraneous factors will overcome that and demand should pick up in rural India broadly.
Okay, sir. We did speak on, what you expect on 2, 3 fronts for FY24. So if you look at consensus estimates, be it those put out by brokerages or even Bloomberg consensus, most of them kind of estimate a 15 to 20% earnings growth in FY24 for the Nifty. So do you think this is achievable or is it very ambitious?
So my sense is that if you look at the various components of Nifty, where banking and allied services, I think that becomes a big percentage, which is almost 40% plus. And there, I don't think so we have any challenges as far as earnings projections are concerned. In terms of credit growth, in terms of, yes, it is some NIM pressure will be there, but that is already factored in, and credit costs, etc. I think the credit cycle has just started. Underwriting standards are very stringent, so even credit costs should not show up. So that part of the earnings projections are all in the bag, kind of, in terms of there should not be too many disappointments. I think as far as IT sector is concerned, there could be communications are always very strong from IT companies in terms of what they expect, etc. So my sense is that there could be some disappointments in that part of the Nifty in terms of the earnings per se.
Okay.
Otherwise, if you look at consumer companies or you look at auto companies, I would imagine that broadly it will be in track or maybe slightly positive uptick you could see as far as the profits of many of these companies are concerned. So on a net basis, I would tend to think that the earnings projection for Nifty, we shouldn't be disappointed, and broadly we are on track to achieve that growth.
Okay, so you're saying early double-digit kind of growth should be doable.
Absolutely.
Okay. So I had 2, 3 questions on the influence of international developments on the Indian markets, because, these days it's all about, what's happening globally. Now, we read a lot about this US Treasury yields rising, be it the 2-year or the 10-year yield, whichever one that we are watching. Now, the question on everyone's minds is, will the rise in Treasury yields actually affect flows into equities in India?
Yeah, I think it is one of the factors which is important as far as the flows into emerging market funds is concerned. But it's not the only factor that works at any point of time. I mean, that's the one way to look at it. I think so. Yes, you do tend to see some more inflows into various emerging market funds or into equity funds per se globally whenever interest rates are on the lower side versus when they move up. So that you have to be there. But I think India is an opportunity, is a unique case by itself where I don't know how there's not a single country of our similar size which is expected to grow at some 6-7% real GDP growth for many years to come about, and the variety of sectors and investment opportunities which it presents to any emerging market investor. So I would say that in retail investors or investors, yes, should be cognizant of important global macros, which could possibly have some impact on FPI inflows. But finally, what boils down to is the valuations and the opportunities of the various stocks that you own, and how can their fundamentals be impacted owing to global factors. So I strongly believe that, and plus also you need to appreciate that we have almost 14 to 15,000 crores of SIP inflows, which has now become the norm. So retail India continues to put its money into the Indian stocks, and there is a long way to go. So global factors are important; we cannot ignore them, but I think the domestic savings, which are regularly now moving into Indian equities, that has become a very important balancing factor, and which is also reflected now in the domestic institutional ownership of Indian equity is at all-time high versus the other way around as far as FPI ownership. My sense is you cannot deny the importance of FPI, but the domestic investors, whether through mutual fund, insurance companies, or directly, now they are coming into their own and they are becoming a very important factor. So broadly, look at domestic fundamentals, look at domestic flows, keep an eye on overseas flows, interest rates, but don't get taken in.
Okay. So you did say that global factors should be kept a watch on. I think this applies equally to the Chinese slowdown, isn't it? So is India going to be a big beneficiary, or is there another side to the story?
I think the way to look at it is that if the number two economy in the world is slowing down, and number one economy itself is going through its own challenges, so collectively it's very important that these two will have a major impact on how the global economy grows. So to that extent, yes, there will be challenges on global demand. So your many exports will get impacted, and if there is a massive slowdown in China, which what we are witnessing, then maybe they will be forced to export at below market prices. So that will also have an impact. So we cannot ignore the slowdown and the financial challenges that the Chinese economy seems to be going through. But having said that, I think we can't look to just sell Indian companies or stocks that we own just because there is a global slowdown. I think we have to look at many more other factors before we take a call on buying or selling a single stock or an individual stock. But yes, China slowdown is a very important consideration that we should be looking at very regularly, keeping a track of it. And how it will impact various sectors and all that.
Right. So one last question, which is, it's always intriguing if investors, look at the rule book and see that in India, earnings yield on equities is always lower than the benchmark bond yields. Which may not be the case in the US, for example. So for the risk that the investor takes, he still gets a low yield. But money still flow into equities in India. So why is this so? And do you see it changing at all?
I don't think so. It's changing in the near term, because I think the amount of the underinvestment which is there in financial assets as far as the Indian savings are concerned, and the under ownership in Indian equity is so high. And I think that is, and plus the growth that the Indian economy and consequently the Indian companies which they show is far, far superior than the growth that the average company in the US shows. And their investment, the ownership is reasonably high as far as the US savings are concerned, which is invested into equity. So I think you'll have to look at both the things. So my sense is that in the foreseeable future, this will continue to remain a situation where savings will continue to flow into Indian equities. Having said that, the size of the bank deposits that Indian investors own. So there is only a small shift which is happening into Indian equities. So it will continue. And the Indian companies are growing far, far superior. So that growth compensates for the loss of yield. Yeah, so I think, and this is again part of asset allocation where, because ownership is so low as far as equity is concerned, I think this will continue for some time.
Okay. Mr. Karwa, it was very interesting talking to you. A lot of questions on every equity market investor's mind, I think this podcast would have addressed. Thank you so much for taking out time and speaking to our listeners. We will definitely circle back to you once again at an appropriate time to get your thoughts on markets. Thank you very much.
Thank you, Vardhini. Thank you for inviting me, and it was a pleasure chatting up with you. And I hope that your listeners had a good 20 minutes.
Yes. Thank you, listeners, for the patient hearing. We hope you have benefited greatly from this conversation with Mr. Krishna Kumar Karwa. If you do like this podcast, please subscribe to Business Line's State of the Economy podcast and also share it in your circles. Thank you.